All right, let's dive right in. We're going to tackle a question that, it affects every single one of us, but almost nobody really knows the answer. And that is, where does money actually come from? And spoiler alert, it's not the government and it's not some giant printing press. The real answer is, well, it's way more surprising than you think, and it's the key to understanding how our entire economy works. So let's pull back the curtain on this illusion.
So this whole explainer kicks off with a pretty personal story. A friend's aunt, she went to her local bank, right? A place she trusted with her niece's entire college fund. But when she got there, the doors were locked. There was this panicked crowd outside, and the truth just hit her like a ton of bricks. The bank simply didn't have the money. It was just gone.
And that right there is the big mystery we're unpacking today. I mean, how is that even possible? You put your money in a bank, you see the numbers on your statement, it's supposed to be there, right? Safe and sound. But the reality of our financial system is so much stranger and honestly, way more fragile than most of us could ever imagine.
To get started, just try to wrap your head around this one number, 95%. That's how much of the money in our economy isn't physical cash. It's not paper notes, it's not coins. It just exists as digital ones and zeros on a computer server somewhere. It's kind of like a shared illusion, this collective story that we all just agree to believe in. And to understand how a bank can just fail, we have to first understand the solution.
See, the whole foundation of this 95% is something called fiat currency. For most of human history, money was tied to something real. A piece of gold, a silver coin. But today, our money is backed by, well, a promise. That's it. Its value comes completely from our collective faith and trust in the government that printed it.
Let's do a super quick history lesson on how we got here. We started with the headache of bartering, like, I'll trade you 3 chickens for that pot. It was a mess. So we moved to commodity money, stuff like shells and stones. Then came standardized coins and paper. For a good long while, we were on the gold standard, which meant every dollar was backed by actual gold. This put a hard limit on how much money could be created. But then, in 1971, U.S. President Nixon cut that tie completely. And with that one move, the whole world just plunged into the age of pure fiat money.
Which, of course, brings us right back to our big question. I mean, think about it. Since 1960, India's GDP has exploded by over $4 trillion. We didn't suddenly find $4 trillion worth of gold, and we for sure didn't just print all that cash. That would cause insane hyperinflation. So, where did all this new money actually come from?
So, who are the real money printers? Well, it's not the government, and it's not the central bank. The answer is actually much closer to home than you think. It's the regular, everyday commercial banks on your street corner.
Most of us have this picture in our heads of banks being like these giant safe lockers. You put your money in, they keep it safe, and maybe they lend a little bit out. But that idea is completely 100% wrong. The reality, which has been proven by economists like Professor Richard Werner, is that banks are literally money creation machines.
Okay, so here's a super simple example of how it all works. Let's say you deposit 100,000 rupees into the bank. The bank is only legally required to keep a tiny fraction of that on hand, say 10%. That's 10,000 rupees. Now, a cafe owner comes in asking for a loan of 90,000 rupees. Okay, get ready, because this is the crucial part. The bank does not give her your money. Nope. They just type 90,000 into her account, and poof! Just like that, new money has been created out of thin air. The total money supply just grew by 90,000 rupees.
But wait, it doesn't stop there. This whole process creates a ripple effect, something they call the money multiplier. So the cafe owner spends that new 90,000, right? She pays her suppliers, her employees. They take that money and deposit it into their banks, which then keep 10% and lend out the rest, creating even more new money. That one deposit you made can end up creating up to 900,000 rupees in total across the entire system. This is how 95% of all our money is born.
But this incredible power, it comes with a massive, massive catch. As Professor Richard Werner discovered, it really matters what this new money is created for. Not all credit is created equal.
And the big difference is this. There's productive credit and unproductive credit. Productive credit is used to fund things that create new value, a new factory, a new piece of technology. This leads to real economic growth. But unproductive credit? That just fuels spending on stuff that already exists or pure speculation. Think about a loan for a super expensive car or a loan to bid up the price of a house. It doesn't create any real wealth. It just blows up asset bubbles.
And when a financial system starts creating way too much of that unproductive credit, you don't get growth, you get disaster. You get massive financial bubbles that always burst, leading to crises and bank runs.
The 2008 financial crisis is the poster child for this. Banks created trillions in unproductive loans, giving out what they called ninja loans. That's no income, no job, no assets to people buying houses. Then they packaged all these toxic loans together and sold them as super safe investments. So when house prices finally fell, which they were bound to do, those investments became worthless. Trust evaporated. Banks stopped lending to each other, and the whole money creation machine just ground to a halt, kicking off a devastating global recession.
And believe it or not, this is exactly what happened to the aunt from the start of our story, just on a smaller scale. Her local bank wasn't buying up toxic American mortgage bonds, but they were creating way too much unproductive credit by lending recklessly to local real estate developers. When that market slowed down, the developers couldn't pay back the loans, the bank's finances were a mess, and, well, word got out.
And that's what triggers a banker's absolute worst nightmare, a bank run. It's basically a crisis of confidence. A whole bunch of depositors realize the bank is in deep trouble, and they all rush to pull their money out at the exact same time, trying to get there before it's all gone.
And here's the brutal, simple math of our banking system. Since banks only keep a tiny fraction of deposits in reserve, let's just say 10%, they can handle normal, everyday withdrawals no problem. But if just 11% of depositors show up at once and demand their cash, the bank will fail. It's not even a question of bad management at that point, it's a mathematical certainty. It's baked right into the system. They simply do not have the money.
So after hearing all of this, understanding how money is made, how fragile the whole thing is, what does this actually mean for you? How do you navigate this crazy paradox? Well, this is where you can gain your ultimate advantage. Okay, first, let's just nail down the 3 big truths here. Number 1, every single rupee in your bank account only exists because someone somewhere owes it as debt. If they can't pay it back, your money can literally disappear. 2, the system is, by its very nature, fragile and built to constantly expand. And that expansion always leads to bubbles, and those bubbles always burst. And number 3, this terrifying fragility is also the engine of incredible innovation, business growth, and economic progress. It's a double-edged sword. Look, this system of extraordinary power and incredible danger, it's here, whether we like it or not. So the real question, the one you need to ask yourself, is how do you use its power for your own benefit without becoming its next victim?
Here's how you do it. First, something called knowledge arbitrage. Just by understanding what we've talked about today, you are already ahead of 99% of the population. Second, learn to use debt productively. Borrowing money to buy an asset that makes you money, like a rental property, can make you wealthy. Borrowing for something that loses value, like a new phone on EMI, just makes the bank wealthy at your expense. And finally, and this is a big one, control your ego. So much of our unproductive spending is just about signaling our status to other people.
This quote just nails that last point perfectly. Savings equals income minus ego. One of the best ways to build real wealth isn't just about making more money, it's about shrinking your ego. If you could avoid the trap of spending money just to show other people you have it, that is a financial superpower.
So that's where we'll end it. The illusion of money is absolutely real. The dangers are real. But you know what? So are the opportunities for anyone who can see through the fiction. So the question is, after everything we've gone through, do you see the system clearly now? And what are you going to do with that knowledge?